Hello everyone, my name is Phương, and now I am the representative of Group 4 to talk more about the case study 2. So now I am introduction about myself. I am an auditing of HAC company, an auditing company. So my duties today is evaluating and giving an idea to accept or deny this client. It's about Adam Paint Company. First, I want you to know more about the general information of ADP. So let's start with an overview. So in terms of overview, we have 3 points. The first one, ADP is one of the largest suppliers of premium paint in Vietnam. It's almost for high-end market. The second one, it has 2 main paint products. It's about construction paints and specialized paints. The third one, it owns a company in Ho Chi Minh City, 1 plant in Bình Dương, and 3 plants in Hà Nội, Đà Nẵng, and Cần Thơ. So next one, we talk more about its history. The first one, in 2003, it was established as a limited liability company. So the next, in 2012, it was equitized in 2008, then was listed on Ho Chi Minh Stock Exchange (HOSE) with code ADP. And the next, in 2021, it was expanded in the mid-range market by buying ABB Paint CO and supplying paint to furniture companies. So coming to now, it remains ethical and trustworthy in the eyes of its customers. So the next, we talk more about its positions in the market. In these terms, we have 3 points. The first one is specialized in industrial costing and high durability technology, with an average output of 5,000 tons for 1 year. The second one is a Vietnam's pioneer and leading producer of pre-coated metal PCM paints, holding the largest national market share. And the last one, it has a strong nationwide presence through a well-developed distribution network.
After talking about the overview of the ADP, now I'm giving definition of 3 sheets. It's about balance sheet, income sheet, and ratio analysis. Let's start with the balance sheet. The balance sheet helps us assess the financial position of a company at a specific point in time. It allows us to see unusual change, trend, or fluctuation in the statement of financial position. It also helps us understand the relationship between different balance sheet accounts, which make it easier to plan the audit and evaluate the company risk. The balance sheet shows the company economic resources, especially the materials and assets used in its operation. It is divided into 3 main parts: asset, liability, and equity. For asset, we look at existence and valuation, and we apply the same idea to liabilities and equity. We also use balance sheet figure to calculate ratio and to check the fraud and material misstatement. Next, we have the income sheet. The income statement shows the financial performance of the company over a period of time. It measures the revenues and expenses, including revenue, cost of goods sold, operating expenses, financial costs, and tax expenses. From this, we can see how the company earns its revenue and assess its overall performance. It also provides more evidence for the going concern assessment, helping us judge whether the company can continue operation in the future. Finally, let's talk about ratio analysis. Ratio analysis helps us understand the relationship between two financial factors, giving us a clear picture of how different numbers relate to each other. It also helps us evaluate the internal consistency across financial statements, especially the connection between the income statement and the balance sheet. This allows us to check whether the numbers make sense together and identify anything unusual. So overall, the balance sheet, the income statement, and the ratio analysis all work together to help us understand a company's financial position, performance, and potential risk.
Overall, I have a main understanding of this company. It's about the company demonstrates strong revenue growth but is experiencing declining economic efficiencies, as shown by reduced margins and a tightening liquidity. Despite a low-risk capital structure, significant fluctuation in PPE, cost of goods sold, and accrued expenses indicate elevated risk of misstatement. And in conclusion, the business is expanding in scale, but facing increasing cost pressures, requiring focused, substantive testing on key expense and asset areas. So we move to the second meaning. It's about identifying potential risks and abnormal items. Okay, initial analytical procedure focus on detecting unusual fluctuation, change, or relationship within the financial statements that may indicate potential material misstatements by highlighting analysts' unexpected variance. IAP helps the auditor identify accounts or errors with higher inherent risk and determine where additional audit attention or substantive procedure are required. The last one meaning for the auditor is planning the audit scope and strategy. The result of the IAP are crucial for determining the nature, timing, or extent of further audit procedure. The auditor will allocate more effort and focus on the areas identified as having a high risk of material misstatement. So now we are coming to what are meanings of initial analytical procedure. We have 5 points in the screen. So now we move to the first one, understanding the entity and its environment. So now we come back to the digit journal. Okay, the first one is in balance sheet. The company maintains acceptable liquidity and a strong ability to settle certain obligations, with no indication of going concern issues. However, significant fluctuation in property, plant, and equipment is about non-current asset. Okay, and accrued employee expense, accounts payables. You can see it is a significant fluctuation. Okay, it presents potential risk of misstatement in asset and expense. The declines in net profit further reflects weaker operational performance. Overall, the company remains stable but contains notable audit risks in PPE, accrued expense that require detailed substantive testing. Okay, so move to the second set. It's about income statement. Although the company achieved a strong revenue growth, approximately 41%, profitability declined across all levels due to a significant drop in gross margin and higher operating expense. Okay, the next one, cost of goods sold increased significantly. Yes, suggesting cost inefficiencies or potential issues in cost allocation. Financial expense rose unusually. Yes, it's about this. And operating cost escalated. The company, as a result, net profit dropped by approximately 19%, and EPS this declined. The company appears to be expanding sales but becoming less efficient. The key audit risks lie on cost of goods sold and operating expense allocation, and completeness of expenses recognitions. And the next one is about ratio analysis. It is about liquidity ratio, activity ratios, profitability ratio, and solvency ratio. In summary, the company showed higher sales activity and improved asset turnover, but its earnings quality and liquidity positions have worsened significantly. Rising costs, lower margin, and tighter working capital management are key concerns, even though long-term solvency remains stable and low risk. Overall, so after applying to calculate the initial analytical procedure, we inspect some abnormal items. So we move to the first one. It's about abnormal item 1. So it's about we can have a possible mistake is revenue overstatement. In the first, net revenue increased sharply by 41.66%, whereas gross margin decreased significantly by 6.9%. Cost of goods sold increased by 54.26%, for expanding the growth rate of revenue. This indicates a high risk of material mistake, maybe some relating to revenue, cost of goods sold, or inventory. The auditor should investigate the following areas. The first is about possible revenue overstatement. So we have some key questions for the auditor in this case. In aspect 1, about class of balances or recognitions in financial statement. We can have some questions like that. Is revenue recognized in accordance with the applicable accounting standard? For example, like Vietnamese accounting standard or international financial reporting standard. Or the second, like are there any cut-off issues, such as recording sales before control or risks are transferred to the customer? And maybe the third, does the company's policies like recognizing revenue when goods leave the warehouse, creating risks of premature revenue recognitions? Look at this, revenue rose significantly, whereas gross profit dropped sharply, indicating a risk that revenue may have been recorded early or not in the correct accounting period. It suggests potential cut-off errors or premature revenue recognitions, where revenues is recorded without the corresponding matching cost. And the possible mistake number 2 is about cost of goods sold overstatement. So in these positions, we can make some key questions like about the errors in inventory valuation. For example, in costing method, overhead allocation, or some obsolete, slow-moving, or damaged inventory not properly written down, or incorrect or overstated material purchase prices, or incorrect cutoff for purchase or production cost. So we move to aspect 2, about the ADP's positions in painting market in Vietnam. We can have some key questions about it relating to revenue overstatement. We can see why in the high-end market the recognitions of revenue sharply increased, and another, why revenue remained the stability wherever its product is too unaffordable for almost range customer in the market. Especially, its events increased sharply by nearly 41.49%. Just calculating about the differences between figure of revenue in 2022 compared to the revenue in 2021, it has fraud or some deliberately overstate the revenue. So we move to the abnormal item 2. It's about understatement of bad debt provision. We can see that net profit decreased sharply by more than 919%, and net profit margin dropped by 5.1%, even though revenue increased significantly. So we can have a question in this: why is revenue going up but profitability collapsing? And the second one, ADP has many overdue receivables, but some are overdue up to 90 days. But the case clearly states that no provision was made. So from a number recall and accounting perspective, this leads directly to a high risk of asset overstatement or relating to profit overstatement, because if revenues cannot be collected, their carrying value is too high and profit is overstated since no expense was recorded. So in this case, the auditor must perform recoverability testing on overdue receivables and challenge management's decision not to create a provision. Okay, so we move to the third abnormal items. It's about exploiting financial expense. Look at the sheet. Financial expense rose sharply, approximately 2,311%, which is highly abnormal. Besides, interest expense decreased approximately 25%, so borrowing cost is not the cost. And after identifying in the sheet, the increase comes from the other financial expense. So we have questions. What exactly is included in the other financial expense? A key factor is that the company imports 75% of its raw material and pays in foreign currency. With the USD exchange rate rising, the company incurred large foreign exchange losses. The FX loss is the main driver behind the sharply increase in the other finance expense. To abnormal item 4. It's about sharply increasing in inventory turnover. In the sheet, inventory turnover increased significantly from 4.06 to 6.83. This usually indicates one of two situation. The first, the company is selling well or managing inventory more efficiently. Or the second situation is about there errors in inventory recording. However, in this case, the gross profit margin decreased. So that is not the reasons about the sales performance actually improved. Because of this inconsistency, it is more reasonable to expect to make decisions about inventory misstatement. So we conclude two possible issues include the first, inventory understatement, leading to higher cost of goods sold, and the second one is about cost of goods sold overstate, reducing gross profit. So in this situation, the auditor must focus intensively on the inventory balance, specifically the physical count, valuation, and calculation of the cost of goods sold to confirm the accuracy of the inventory balance, as this material impact the profit matrix. So now it is the end of our presentation. So thank you for listening.